Ashish sir, you can start the webinar.
Yeah, good evening, friends, and warm welcome to all the eminent panelists and the participants for joining with us in this today's webinar on regulatory changes by RBI and impact on the health of NBFC and way forward. So it's a very, very important topic to discuss in this today's parlance. And you know that the contribution of NBFCs towards supporting real economic activity and their role as a supplemental channel of credit intermediation alongside banks is well recognized. And over the years, the sector has undergone a considerable evaluation in terms of size, complexity, and the interconnectedness within the financial sector. And many entities have grown and become systematically important. So some of the entities have become the larger than the banks also, some of the small banks. So it is very, very important to discuss the recent changes, the regulation by RBI on the various categories of NBFCs. So friends, as you know that NBFCs are, I think, NBFC, HFCs and MFIs, all including, I think they have more than, I think 15 or 20% of the market share of the entire lending industry in the country actually. And fintech is now also growing in a big way. So today we have organized this webinar where we have the panelists who are from the NBFC sector, from the banking, small finance bank, and we have CEOs, CIOs, and the CFOs. So I think it's a very good panel where we can discuss in detail about the many new changes. What will be the impact on the entities, on the small NBFCs and the large NBFCs also, and the ultimate borrowers. Because when we are talking the NBFC, we need to talk about the borrowers also. So I would like to just run through a small PPT, which can give you the glimpse of the latest changes or amendments by the RBI in the NBFC sector. So RBI has come out with 3-4 circulars in last 6 months, and if you see the NBFC, this whatever the regulation, I think in 1964, the chapter 3rd(b) of the RBI Act regulation started the deposit taking NBFCs was introduced actually. And after that, there were many new things. So the RBI has done many changes many times, and they have increased the limit of the minimum net worth or minimum equity from 25 lakh to 2 crore, 1999. Then there were the classification of NBFC as NBFC ND, and then NBFC NDSI, and the Tier 1 capital have been classified also. Then in 2021, the new framework, skill-based regulation came in the picture. So time to time, the RBI has taken these steps to basically regulate the NBFC in such a manner where the risk should be less, and there should not be any big, I think, challenge. Although in the past we have seen some large NBFCs have gone into problem. So keeping in mind, the RBI is now making the regulation at par with the bank. So we have experts, they will discuss with us that how these regulations are coming at par with the banks actually. So I'll cover up these 3-4 circulars, which are the latest circulars. So one is that a skill-based regulation that was issued in the month of October 2021. Then the prudential norms on income recognition is basically related to asset classification. It was again issued in the November 12, 2021. And then the third one is the PCA. So I think this has come first time in the NBFC history, where on December 14, the RBI has come out with the PCA framework for the NBFCs. And the last one is the master direction by the Reserve Bank of India on the microfinance companies, which has come in the March 14, 2022. So these are some of the new regulations which we'll try to discuss, and our experts will go in detail about the I'll just touch upon the regulation. And so you see, as per the circular which was issued in October 2021, the RBI has classified the NBFCs or HFCs or MFI into four categories, or all kind of NBFCs into four categories. So base layer, middle layer, and upper layer, and the top layer. So base layer, they have now classified up to 1,000 crore of asset size NBFC will be covered under the base layer. Any NBFC which is less than 1,000 crore of asset size will be the part of the base layer, and then middle layer, which is above 1,000 crore. So, and all deposit taking companies. So any company which is deposit taking, even it has even 100 crore of portfolio, 100 crore of asset side, it will come under the middle layer. And the upper layer is, I think, something which the RBI will find out the top 50 companies. Out of that, they will cover up the 10 companies which will be the upper layer. And the top layer is the as per the discretion of the RBI, they will cover up the companies which are in the top layer. So there are a lot of sub clauses within the top layer, upper layer, and middle layer, and base layer. So we'll go in detail once our experts will discuss, but I will cover up in a small this thing. So that is one thing. And other than that, the RBI has come out with some kind of the increase in the minimum capital requirement also, which is in phases. So from 2 crore to 10 crore, this will be required by 2027. So next 4 to 5 years, any NBFC which want to set up the business, they have to have 10 crore of minimum net own fund, or the existing companies have to convert their or have to reach that limit from 2 crore to 10 crore. That is important. So the same way it is for NBFC, MFIs also, and NBFC factoring also. And one more thing is the NPA classification. So now the base layer NBFC have to classify their NPA from I think 180 days to 90 days in a phased manner, where this to 150 days by 24, and then 120 days by 25, and 90 days by 26. So this is again, I think phase by the RBI is planning to cover up the base layer NBFCs to be at par with the banks, where the 90 days norms should be adopted by them. But I think the major advantage is that this 90-day norms is now applicable up to 1,000 crore of NBFC. Earlier, I think it was applicable to the company which are less than 500 crore. So under this new regulation, this will be the advantage for some of the companies which are between 500 to 1,000 crore, as per my understanding. So the conclusion to this SBR regulation, I think the master directions are good for the future, and but there are some observations which we have come out after that discussion. This circular, reading the circular. So I think RBI has made it compulsory that the NBFCs should have the one director should have the experience of the banking or NBFC. But practically, the experience is not the only thing. There should be the minimum, I think, experience period should be there, and the experience position also is important. So just for example, if somebody has 1 year of experience in banking and then NBFC, and if it is qualified by director in NBFC as per the RBI norms, I think it will not serve the purpose. And even the position also, if somebody who was at the very lower level in the organization and he now appointed as director, so it will not also serve the purpose. So there should be, I think, in addition to that, this director in the NBFC and bank earlier experience, they should put some kind of condition or some kind of additional thing where minimum experience and the position at which they have worked, it is important to cover up. Then the core banking solution is another area where the RBI has made it compulsory that more than 10 branches, NBFC which are having more than 10 branches, they have to have the CVS. So we will discuss on this whether this will be feasible for the small NBFCs over the period. Then there is the classification which has been made it is based on the NBFC to NBFC. So suppose there are NBFCs in the group, there are 2-3 NBFCs which are in the holding and subsidiary category categorization. But practically, if you see the holding company is having the less than 1,000 crore of asset size, and the subsidiary company is having the more than 1,000 crore of asset size. So there will be disparity because then the subsidiary will be in the middle layer, then the holding will be in the upper layer. So this will, I think this need to be also balanced, where I think all the company which are under the one umbrella in the NBFC category, they should fall in the same layer actually, which will, I think, be the more helpful, or I think in a better classification. Then other than that, there are some more observations, like the RBI has said that the government NBFCs will not be covered under this regulation for a time being. So I think the government NBFCs are very large in terms of their size, their the CAR and all. I think is very, very low. So these should also bring as fast as possible in this kind of layer, so that the risks should be I think managed in a better manner actually, and the industry should know that the government companies also are on the level playing field with the other NBFCs. That is one thing I think which need to be seen. So these are some of the observations from our side on this circular, which we will discuss in detail with our experts. And other than that, on the SMA and NPA classification, so now the RBI has classified this SMA 0, SMA 1, SMA 2. I think it was there earlier also for the banks. And the only thing is that now the classification should be on the day when the account has become overdue. Earlier, there was some leeway where it can be done at the end of the month also. So this might change some kind of economics on the NPA side of some of the NBFCs. And this includes all the loans, which are whether retail loans or the other loans, irrespective of the any exposure, any kind of exposure. And the one which good thing which the RBI has did, that the NPA or the loan which has been classified as NPA can be upgraded only after the standard category, only after the full the arrear have been paid. So whether it's interest or principal, it should be paid completely, then it can be upgraded. Otherwise, it will not be upgraded to the normal standard category. So that's a good thing which I think the RBI has covered. On the PCA framework, if you see, this RBI has tried to cover up or try to bring the NBFC in parity with the banks, where the phases they will do it. So there are 3 threshold, I think, area they have given, which are the CRAR is one of the area, then the tier 1 capital, and the NNPA basically. So if these ratios will be lower than the as per the minimum standard in the certain categories, these so any of these 3 will hit the lower category. These companies will be classified as PCA. And they will be having a lot of restrictions. So if they are into the category 1, then they cannot distribute dividend. They cannot basically infuse. They cannot basically have many things. So this we will discuss in detail also. And in RT2 category, along with the 1 category, they cannot expand the branches. So practically, the purpose of RBI is to restrict these NBFC which are having the risk in these 3 categories in terms of CRAR or the NPA and the other thing. These NBFCs will be restricted to do the business practically. So this is another aspect which is, I think, helping, which will help NBFCs to, I think, uh, keep watch on their different parameters, so that whenever these parameters are going below the standard limit or the limit prescribed by RBI, the NBFC should work hard and to maintain these parameters. And in the last, I think the latest circular by RBI for microfinance companies. This is a very good circular from the industry point of view. There are a lot many things which have been, I think, relaxed or liberalized. If I just read, I think now this collateral-free loans have been basically allowed to the individual who has the household income of more than 3 lakh rupees, and this household income, they have covered the entire family, not only the individual. And the one good thing is that this end-use restriction has been eliminated. Earlier, I think it was only for income-generating loans. Now, even as per our understanding, even the consumers' loans can be covered in that. So we have Mr. Sayyed, who will be in a better position to guide us that what is the right, what is wrong in that actually. And other than that, I think there are some more restrictions that the loan repayment obligation has been kept at maximum 50% of the monthly household income, and this microfinance loan pricing to be based on the board approved policy. So I think this is again a big thing, it's a game changer. It can be a game changer for some of the NBFCs, where the interest rate cap has been withdrawn actually. So it will again depend on the fittest will survive, but definitely some of the small MFIs, those were struggling because they were not getting money at the lower rate, they might get some kind of advantage if they are into deep rural and they can get the better rate of better pricing from their borrowers. So this can be the advantage for them. But for the larger end MFI and all, I think this will depend on the fittest will survive. And other than that, there are many other things which have been covered. So we will discuss in detail. One more important thing which has been covered in the circular is how this qualifying assets. So as per the earlier circular or earlier guidelines in the MFI category, 85% assets would be as per the qualifying assets. Qualifying assets means which are as per the RBI guidelines should meet out the norms. And now it has been relaxed to 75%. So the MFIs have this advantage. This up to 25% of their total assets can be other than MFI category of qualifying assets. So they can do either the housing, they can do MSME, they can do selling. There can be many things which can be done under that, which will help, I think, to MFI maybe in some way where they can offer the additional product to their existing borrowers and even the new borrowers also. So this is something which I would like to cover from my side, so that we can warm up the discussion. Where I believe that this will I've tried to cover these some portion of these circulars or these guidelines which have been issued by RBI. But definitely we have experts who will discuss in detail and they will guide us that what will be the impact of these guidelines on the growth of the NBFCs, on the impact on the borrowers. So friends, we have very eminent panel actually, and very senior people are there who are veteran in the industry. And so we have DS Tripathi ji. Tripathi ji, the CEO and MD of Aadhar Housing Finance. He's an ex-banker also. So nobody can be better than him, basically, who has seen the banking. Now he's the top person in one of the large housing finance company. So Tripathi sir is having very, very good experience on both the side. And he was, I think, the GM, he was GM of Union Bank of India. It's a very large bank in the country. And so Tripathi sir, first of all, I would like to welcome you and thank you very much for joining with us. And you see these guidelines or these circulars which have been issued by RBI are good in the spirit from the RBI point of view, or I think as practitioner or as HFC, what I have observed in the scale-based or the layer-based approach, this housing finance companies have been covered under the middle layer. So any housing finance company which is even less than 1,000 crore of book size, even 10 crore of book size housing finance companies will come under the middle layer. So why it has been kept like that? Because you see that then they have to follow the many stringent rules and all. So what do you think about that? The companies which are into the small category, will there be any impact on their growth, or there will be the more I think compliance which they have to follow? And other than that, I think if we see from the HFC point of view, what do you think? This is a level playing field from the banking and HFC point of view, or there is something else in the mind of the RBI? So I would like to invite you for your deliberation and how this regulation will, I think, shape up in the future. Over to you, Tripathi, for your comments and your deliberation. And I hope so that you have very good knowledge. The audience will get that advantage of. Over to you, sir.
Yeah, thank you, Ashish. Thank you. If you ask that why the RBI has kept NBFC up to 1,000 crore in base layer, while all HFCs are kept in the middle layer, apparently there appears no logic. There must be something in the wisdom of Reserve Bank of India, I would have thought. But what personally I feel, and that should be the big logic, all the loans of NBFCs are for the period of 1 year, 2 year, 3 year, maximum 5 years. You see, the infrastructure loans, whether NBFC is small or big, they have kept in the middle layer. So wherever the loans are for long-term period, those either NBFCs or HFCs, they have been kept in the mid layer. All HFC loans are ranging from 20 years, 25, 30 years. Long-term loan period is there. That's the one very big logic which goes in the in explaining why RBI has thought to keep in the mid layer. That is point one. Second, in case of earlier, up to 100 crore rupee asset size, HFCs were treated as the small HFCs with light touch regulation. Rest were having the non-light touch regulation, the normal regulation. But if you see the difference between both, that has been still preserved. Though they have been kept in the middle layer, the circular, detailed circular on the housing finance company, which was issued by Reserve Bank of India, it is separate from NBFC. 90% guidelines applicable to NBFC has been incorporated in HFC guidelines, but still it has been kept separately because of the special nature of lending which housing finance companies does. Only one thing RBI has still given exemption to small HFC, that for all HFC to 50 crore rupee liquidity management framework, they should start making through the board policy above 50 crore. Now see, the differentiation is kept, though all are in middle layer. For the purpose of chief risk officer, 5,000 crore rupees asset size is taken for appointing CRO. Below 5,000 crore HFCs are exempted. So now your point is that why they have kept middle layer, though they are kept in middle layer, but RBI has kept in mind to give some light touch regulation to the small HFCs. Second thing, for liquidity coverage ratio, 10,000 crore rupees HFCs, they have to immediately start from December 21 to maintain LCR in graded manner by December 24. For 5,000 crore rupees above HFCs, they have to start 30% from December 20, but if both the companies have to reach for LCR by December 24. This is not applicable for HFCs below 5,000 crore rupees. So I think this answers the question, while RBI decided to keep on the nature of long-term loan, to keep in the same bucket, but the certain differentiation they have kept with regard to the board appointment, with regard to everything. But for the purpose of risk management committee, They wanted both should have, excepting having CRO over 5,000 crore rupees. So I think I answered this question, what you asked. That is the main logic, which RBI has properly taken care. For the HFCs above 5,000 crore rupees, the guidelines are very wide. IT management guidelines, audit committee, all guidelines are applicable for them, which for any NBFC or HFC are applicable, but exposure limit norms are applicable on both of them. Now, the next question which you have asked, whether RBI is thinking something more, or whether the regulation between the bank and the HFCs are aligned. Regulatory arbitrage has been removed. There is no regulatory arbitrage now, whether NBFC or HFC. And why RBI has been doing? Because of the growth of the financial system and interconnectedness. The Reserve Bank of India has gradually come out, I think, more than 7-8 circular on different topics. Where you mentioned, there are other circulars also with regard to auditor appointment and everything. They are harmonizing the regulation with the banking system. So now the NBFC, HFC can only claim we are not allowed to take CASA, we are not allowed to take deposit, only if you are allowed to take deposit, while banks having advantage, but the regulation are almost applicable. That is in both the HFC or NBFC, whatever you have just shown. The only difference is left out. The banking system is now having the external benchmark for deciding the home loan rate for the individuals. While the housing finance company, they have still not brought into the ambit of the external benchmark rate. They are still having their own internal benchmark and they are charging rate to the customer. But with regard to transparency, communication, NPA classification, everything is 100% harmonized. There is no difference. Now, external benchmark, RBI might bring any point of time, but why it has not been brought? Because the cost of fund of HFCs often varies. Sometimes they have huge market, capital market exposure. Sometimes they have banking sector loans. Sometimes bank increases the interest rate. The HFC's cost of borrowing in the benign environment is very low, but in the difficult environment is very high. One HFC to other HFC, the cost of fund varies because of depending on size and the parentage and the rating and all that. But I believe that the external benchmark rate, if RBI decides for HFC, that can be implemented. That is what my mind says. It's only thing where HFCs may get a hit. And if you say hit or anything, whatever regulation was brought, they pinch the sector for some time. But with the passage of time, everybody get aligned. If we have to operate with the business in the marketplace, we have to align with the regulation. The only request to that regulator, that NPA norms you have just shown, which have been now completely aligned with the banking system, though they have given leeway till September 2022. But most of the companies were listed, they have already implemented because the guidelines for extension came on 15th February, while 14th February was the implementation date of the guidelines, publication of balance sheet. So now my company or many NBFCs which were listed in debt market or in capital market, they have already implemented the RBI guidelines. I don't think that they are going to roll back to take advantage of September 22. I believe we should not roll back. Any problem which has come out of September 22, it is better we should accept it now and try to see that we change the behavior of customer. What happens in the very low income segment or in the small loans of truck operator, in case of NBFC I am touching and housing finance also I am touching, these guys, sometimes they are not able to pay within 90 days and they pay, they always keep their account within 90 days, but they don't pay the entire overdue if account becomes NPA. But in 90 days DPD comes in, account become NPA. And it can only be upgraded when the entire overdue is paid. So in that situation, the small borrower, the truck operator, a small vegetable vendor, whether they take home loan or they take the NBFC loan, for them, coming out NPA will be a challenge. But I believe this system may take 3, 4, 5 quarters. The market will get aligned and NBFC, HFCs will also get aligned and they will adopt it. As we have adopted NPA norms from 1 year to 6 months to 3 months, and now we have been working for 3 months from like more than 10 years. Same way, the present RBI norms will also get adopted. So I don't think that regulation brings discomfort in the beginning, but it is good to do the business in a more orderly manner. You are on mute.
Thank you, Tripathi sir. I think you are very well covered. I think you have already given the message that the RBI now coming up to harmonize the regulation between banks and NBFCs. So I think this will go further also. Whatever has been left, I think.
And just Ashish, I tell you, there are certain norms which are beneficial too. What problem sometimes we small companies face? I will not get liquidity. So RBI has brought co-lending. They have said, why you want liquidity? You go for co-lending, you get your own spread. You don't require huge capital, you don't require more borrowing. Secondly, for securitization and sale of loan exposure, the guidelines have been liberalized. Instead of having the seasoning period, holding period for 12 months, they have brought to 6 months. You complete due diligence done, even that period is also made to 0. There are certain regulations which are enabling the business of the small HFCs and NBFCs, because RBI recognizes that these are required to be in the system to reach the last mile person. So I don't think that every regulation is going to put us in tight spot. Some of the regulation are enabling also for doing the business. Sorry, I took this longer time.
No, sir. Thank you very much. I think you're very well covered. But still, my question will remain: the HFC which are small, they have to face some kind of I think stringent regulation other than the regulation which is applicable to other NBFC in the base layer. So they should be kept in that same I think layer, and maybe after certain time they should be moved to that layer. That will be I think more beneficial for the HFCs. But no, I think depend on the RBI thinking. As you have already rightly told, that is a long-term portfolio and all these things are there. So keeping in mind, the RBI must have considered these things. So thank you, sir. Thank you once again. I think it's a good deliberation which we got a lot of insights from you. Now we have Sanjay Doka ji, who is the CEO and CFO of Ambit Finvest. Ambit is a well-known name, and Sanjay ji is with this company, I think, more than 10 years. So the inception of this company is associated. Before that, he was with many other NBFC, large NBFCs, Karpi, Anand Rathi, Aditya Birla, and he is a chartered accountant profession. So nobody can be better than the CFO, because ultimately the CFO job has been, I think, make it complex by the RBI. So I think Sanjay ji, we would like to understand from you. First of all, welcome to you for joining with us. And this is a Sanjay ji, I think, initiative. Because he told me that we should organize something on the NBFC new regulation so that the other industry fellow members can get the benefit of it also. So thank you, Sanjay ji, for giving this suggestion to me, and I could make it, I think, today this webinar. So Sanjay ji, this as we have discussed in the circular, that RBI has made it this NPA norms, which are now this thing that even at day one, if they overdue, you have to classify under the particular category. So earlier, what we understand that NBFCs were, I think, doing the month closure, and that time they were seeing whether they have to classify it or not, keeping in mind the money has come or not. So just for example, the installment was due of 8th of the month, and at the end of the month, the money has come maybe on the 16th. Then this account was standard. There was no classification of SMA at that account. So what will be the change, and will there be impact on the health of the NBFC? Tripathi has also covered to some extent, but because you are into the MSME lending or the supply chain financing and the other related areas of lending, so it is something different from HFC. So what do you see that there is any heat on that? And Tripathi has told that they already covered in the March numbers, although the RBI has, I think, gave it the time for September, till September. So we would like to understand from you. And on the other side, the PCA norms, which has been announced for the NBFCs. So will it impact a lot of NBFC? What do you see? Because you have a lot of experience on the NBFC side. So in our country, do we have this kind of situation where many of the companies will come out with that parameter, or they'll suffer because of that? So over to you, and thank you very much.
Thank you, Ashish. I think You said rightly that, I have only that day told you that you should do such kind of seminar, because in last 6 months, if you combine extend to 12 months, or, there are a lot of changes in by the regulator to the NBFC and HFC and microfinance. It started from, Tripartite said rightly pointed out, they also touch with the auditors engagement, and how many audit one a chartered accountant and a CA firm can do, and for what period. That also, change the whole audit space for the NBFC space. So like us, we were having Big Four as an auditor for last 4 years, but because of these changes, Big Four was not available to a small kind of NBFCs, where, they say this is not capturing that kind of revenue. So, and then also there are changes in number of audit and number of years. So what RBI is doing in last, let's say, 12 months, they are also, one is they are making various regulatory changes, which makes NBFC more stronger than ever before, because they also seen in last 2 3 years where large NBFCs like ILFSN and DHFL have gone through various kind of issues, and which impacted the whole financial system, because NBFCs now in India and across the globe plays very critical roles. So if any large NBFC which is not so regulated by the, or not so regulated by the regulator, then there may be an impact on the whole financial system. So what they are doing, one hand they are putting some more regulation, which is making them at par with the bank, and making more supervisory and more control in nature. And also other hand, they are also kind of facilitating them with providing more kind of liquidity, where they can source funding, because it is all about, getting money with the uh, getting money with the easy sources, and also then deploying with the more controlling environment, more regulatory environment. So as Tripathi is touched upon, because there are two types of circular stock RBI clarification, which one is like co-lending and securitization one, and they have given various leeway to the NBFCs. Now, if you see, there are a lot of co-lending and securitization activities happening in last 6 months. Other hand, the various controls and checks and balances on NBFC's operations. Now, coming to the specific two, which is your, you have covered slightly in the circular, your presentation also. One is the NPA recognition norms. So RBI issued this as just a clarification, because they were in their mind that everybody has to follow that 90 days on the day end basis, not on the month end basis. And also the rollback of NPA is has to happen once you recover the full overdues, which include your principal plus interest. But what is happening, because over a period of time, NBFC has from 150 days to 120 days to now 90 days, but it was being done at NBFC level at the month end process. Largely, all NBFC were following that methodology, where EMI may be due on 5th, 10th, 17th, the specific repayment cycle. But the processing of the DPD, stock SMA reporting, and stock NPA calculation was done on the month end. It was typically giving NBFC a 15 to, no, if it normal EMI is due on 5th and you are doing in 30th, which is month end, it was allowing NBFC to put more collection effort, and then improve your balance sheet 25 days more, and then in same pattern the borrower also habitual, because 5th is the cycle, they are not paying, and then but by before month end they clear this overdue, and that is what happening. So typically there was a bucket of, let's say, depending upon which segment you are. If you are an SME pure secure lending, you may have 1 to 3% such bucket kind of, which is ranging between these people. These are the typical borrower, because they have some liquidity in system, but because of the cycle they want to enjoy this 25 days additional, and they are just pay before the month end. That RBI said now on 12th November onward, this is a clarification, this you need to stop immediately, and going forward you have to do. One is day-end accounting, when if it is a 5th December is due date of EMI, and the client is not paying on that and it's coming to 90 days on that particular date, then you need to classify this as an NPA. And second, more critical changes is you need to clear the full overdue amount, which include all the EMI and all the principal. Earlier, what was happening at NBFC space, that if client is cleared only one EMI and it brought back to less than 90 days, then it is again rolled back to standard assets. So these two changes, RBI said you need to implement immediately, and accordingly, all listed NBFCs, which has come out with the results, and some debt listed NBFC, whether equity and debt, both had closed this and they have implemented this. And if we have seen the impact, it is ranging between 1 to 3% on their GNPA number, depending upon which business segment these NBFCs are there. There is a impact of 1 to 3% of these two circular. There is one more challenge, that because this has to be done through system, various NBFC and the body has represented to the RBI that system is not ready to make these changes, because the day end process and month end there is changes, and also the rollback of one EMI versus the full overdue is also getting some challenge. So RBI has come out with a 15 Feb circular where they have given a extension stock. Also, there is a deliberation issue. Somebody say it is a extension only for the system implementation, and some are saying it is a extension for the full circular, because remember the original circular is talk about only clarification. There was no specific circular. They were saying it is a clarification. You are not doing, you do it right now. And 15 Feb circular talks about extension to implement the system. So the different views are there, but largely basis discussion with the auditor and what listed company which has, because large player have already implemented this system. Like us, we have already implemented in December. We have that listed entities, so we have already implemented, and we have seen around 1.5% headline number impact on the GNB, because as I told you, there is a bucket which is ranging between 60 to 90 days bucket, and largely it is 1 to 3-4% in everybody's pool. It will take certain time to percolate this to borrower community and educated them. Now in a state of 90 days you have to clear this and due date, and if it is going one day beyond, then your account will be NPA, and once it is classified as NPA, there will be a lot of replication starting from their CIBIL score and their ability to borrow further. So yes, immediate impact is, I think, is visible. It is there, 1 to 3%. Everybody's number has been hit, and then if GNP number is there, then there is an impact on profitability by way of your ECL. If you are India's compliant, then your credit provisioning has hit. But if you see from the long term and that perspective, it is a very good move in the right direction, because it will further discipline the borrower part, because they know, yes, if I not pay in the due date, then my civil, my credit score and my civil score will impact, and it may take maybe around 3 to 4 quarters. But my own feeling is this is a step in right direction from the betterment of industry perspective, and also from the overall borrower point of view also, because if they are kind of in keep themselves disciplined in paying on the due date, then there will be lower risk their account being then transferred to the NPA.
Right. So I think very well covered, Sanjay ji. I think in very detail you have covered this thing. So there will be impact of 1 to 3% as per your observation, and it may take 3 to 4 quarters to come back on the normalization this process.
Asking, coming to your other question, which is on
PCA part.
From corrective action, this is also largely an outcome post this 2-3 large NBFC falling in last 2-3 years. Then it is indeed very important from overall financial market perspective that regulator keep more controls and supervision on these large NBFCs. So it is again a move in right direction where RBI just want to ensure that the key financial parameter like our cards and net NPA and Tier 1 capitals are maintained in a very well accepted level. If you are going below these levels, then the RBI will have to put certain more control and to say put the under a watch list, and then the basis this parameter RBI has come out with rightly three categories. So this is again a move from in very well thought of and very well in right direction, because banks are anyway with this view, and we have seen in last 3-4 years what has happened to all the public sector bank, especially how ruthlessly they have lending, and then one by one they have gone into the PSA framework. Now there is government is there, they can kind of bail out and do something, but in private it is very difficult. So again it is a right move by the regulator basically.
Okay. Thank you, Sanjay ji. So I think from the industry point of view, both the I think the regulation, whether it's a SMA or it's a PCA, both are welcome because this will bring the efficiency, or to some extent this will bring some kind of decorum or some kind of, I think, understanding where the companies will focus on these areas and they will do better and better actually. So thank you, Sanjay ji, for giving this positive note. It's a really good thing. So friends, now we have Mr. Dominic Vijay, who is the Chief Technology Officer of Art Housing Finance India Limited. Mr. Vijay is having very good experience of working in different kind of organizations. He has worked in the large organization like the Oberoi Group, Air Deccan, Kingfisher Airlines, Max Ventures, and many other organizations. And now he's working in NBFC, HFC rather, and he is electronic graduate also. So he has done a lot of, I think, technology development, technology innovations also. So Vijayji, as Sanjay ji has told that this NBFC, some of the NBFCs approach to RBI, they're asking the time, the system is not ready. That is one thing, I think. So that job come on the soldier of the technology officer, because any change. I was reading somewhere that the banks or NBFC are not the lending company; these are the technology company practically. So anything changed by the RBI, anything changed by the regulator, it immediately comes on the head of the CTO. So how do you see the changes are impacting the operations or the growth of the NBFC, or practically what basically the changes are impacting on the overall the technology part, or this making the job of the technology department the more cumbersome? And are these NBFCs are ready to take the challenge, or these SMA also, which is, I think, reporting on the daily basis and all, which is a lot of job actually. So keeping in mind all the changes, what is your take on that? I think that will be the better question from you. So over to you, sir. Thank you very much.
Thanks, Ashish, and good evening, everyone. Ashish, there are two things to it. One is whenever a regulator releases any kind of changes in the systems or in the process, it is mandatory that we have to implement. There is no second thought to that. Okay, another one is the kind of technology we have it, because normally HFCs or any NBFCs which are already in the industry from a very long time, I'm not talking about the fintech, purely who are in the industry from quite some time, they work on hybrid model. We still follow the legacy process. Yes, we have a platform to work on it, but we still follow the legacy process. But with RBI tightening the screws and putting process in place and seeing that there is no kind of any kind of leakage or any kind of misappropriation of the complete process, it is mandatory for us to get things in place. And as a CTO of my for present organization, HFC, where I work with, one is, if I tell you, the SMA, which was the asset classification, which is very, very important. There was too much of pressure on us to get things moving, and there was a deadline given to us. And in our organization, what we have done, when we implemented a core lending system, it was very well planned that system has to be implemented with us in such a way that it's flexible and scalable, keeping in mind a lot of changes coming up, whether it is a regulatory change or the business change. In that way, we were able to implement the asset classification in our present system. And only thing, we were not able to test it full-fledged and go live on it. It was more at the UAT level. So fortunately, we were on the good side that, the date was extended till September. So the management has told me to hold it, not to go live immediately. Yes, system, we had a little bit of challenges. The challenges normally what we face when implementing any kind of new technology or any kind of changes in the existing system. That's very thing. One is business requires it very urgent. Second thing, the changes which has to be incorporated in the system doesn't support us very urgently. I mean, it is not that an easy task to be done. It's a very huge task. There's a lot of development gets involved depending on the kind of changes. This will have a lot of impact on the core system, the business operations. Whatever I do, I should be in a position of seeing that, there is no impact on my day-to-day operation, whether I implement new things or old things or make some changes on my system. So I need to be very, very cautious on that. Test it and go live. Post go live, there'll be a lot of issues which I need to address it, get things going. But this one, when you look at the kind of NBFCs or HFCs presently who are working, they all are right now. I think every organization is investing a lot of money on the technology part to accept these kind of changes which is going to come forward, because RBI is very, very clear on it. When it released the IT framework some years back, I think 2-3 years back, it made it very clear that you got to have a set of rules, policies, regulations, board approved policies. Everything has to be in place, multiple committees. So it was already been the roadmap was drawn. So in that way, we were able to successfully implement certain things. Yes, certain things always a challenge which we don't do it. We take an external support. That overall, if I look at it, implementing a regulatory change is mandatory for us, and taking that. Whether it's going to successfully work or not work, it is totally the CTO's job. And after implementation, post support, and especially when it comes to changes which are more at the application or at the core database level, there we face a lot of challenges which we have to overcome. There is no alternate option for us. It has to be done. It has to be done. That's how it goes, Ashish.
Okay, so blindly accepted, basically no excuse actually.
No second thought about it. There's no second thought.
To do in any way actually. So great. So thank you very much. I think your views are very, very important, because technology is playing an important role actually.
Yeah.
So thank you. Now we have Sri Sadab Sayyadji. Sadab ji, the Chief Executive Officer of Muthoot Microfinance Limited. And he the person who has almost 11 years of working with this group, this Muthoot Papachand group. And earlier than that, he was with many other organizations, which are banks, HDFC banks, India Bulls Credit Services, GE Countrywide, then the Satin Credit Care, Spandana Spurti. So you have with a mix of experience banking, NBFCs, MFI, and again MFI. And you are the part of the group where you have housing finance, you have MFI, you have NBFC. So all kind of categories of NBFCs are there within one group. So first of all, Sadabji, thank you very much for joining with us and for your confirmation also. And you are CEO of the microfinance company. So this latest circulars which has come from RBI on the MFI, I think it's a welcome move by the entire industry, which I've seen in the newspaper and all. But still, I think there are many things which need to be looked at. So what do you think this circular will help the diversification of product, growth in the portfolio? That is the another area. Then basically interest rate, whether the MFI will increase the interest rates, or will there be the impact on the borrowers, because till now the borrowers were under this thing that there is a limit for MFI. So these are some of the issues which are, I think, struggling or discussing in everywhere, that what will be the fate of the issues, or what will be the impact on the NBFCs and the borrowers, and how these small MFIs will be in a beneficial position, because they were getting funds at the higher cost, and they were pissed off because of that, the 10% margin and all these things. Other than that, there's another question which is related to the group level monitoring, actually, which I touched upon in my presentation. That RBI has not covered. I think in the entire circular chain of circulars, they have given clearly the entity-based regulation. So what do you think? There should be some kind of group level monitoring concept should also be there, which will be helpful for the company, the groups which are into the different categories of NBFCs. So over to you, and thank you very much, Satabhi.
Yeah, thank you, Ashish ji, for inviting me, and thank you for creating this panel and discussion. I think this was the need of the hour. I think the good part about speaking after a few eminent speakers like Tripathi ji and others, that most of the part they have covered, but I'm happy to share my 2 cents. I think all of this, these circulars that have come from RBI over the period of time, be it harmonization of regulation or some stage-wise regulation, AUM specific regulation, NPA recognition, and now the RBI circular for MFI, all of them are working towards a harmonization of regulation kind of a framework. So I think the biggest outcome of this NBFC related circular is harmonization of regulation. And I can tell you, this was one of the biggest area of concern, and we had a situation where there were multiple type of NBFCs who were operating on NBFCs and other entities operating in microfinance arena, and there was a regulatory arbitrage. So there were banks, full commercial banks, there were SFBs, and there were NBFCs who were operating in that area, and then there are NGOs also who are operating Section 8 company. There were regulations which were very well defined for NBFC MFIs, which had a lot of kind of structured framework in terms of what pricing should be, what margin should be, how much we should lend, and to whom we should lend. But the same things were not applicable to certain players like banks, SFBs, even NGOs. So I think the biggest achievement of this circular that has come out is they have ensured that there are complete level playing field for everyone, and I think that is the way it should be. And the core of this circular is on the client protection. So the RBI does not want any of the customers to get over leveraged. So that's why they have designed this regulation. The main feature is the definition of microfinance. It has changed completely. The only difference in microfinance now is only thing which is defining is that the loan should be given to a household which is at less than 3 lakh rupees of income, and it should be collateral free. So as long as it is collateral free, it is and it is given to a household which is less than 3 lakh, then it's a microfinance, and it doesn't depend on which entity is lending to the customer. So that is the biggest part of it. The second part, I think, how to calculate household income and how to look at the household as an obligation is something which is very, very important, because I think in normal underwriting, which is anyhow and housing finance is doing or any consumer lending is doing, they are looking at a overall obligation of an individual and a household and then deciding a loan. In microfinance, that was to an extent not getting done. But now I think RBI has done a good job in terms of putting an FOIR kind of a rule that FOIR has to be 50% or lesser, then only you can lend. So all the obligations are getting covered in the kind of liabilities of the household, and then the loan is given. So that really ensures that the household is not over indebted. And this will also lead to harmonization in reporting to the credit bureau. So one of the biggest angle of this is that impact on the credit bureau report and the reporting. So even the other non-microfinance entities would have to report certain information. In fact, just before this call, I was on a credit bureau task force calls, which was called by RBI, and we were discussing about what kind of changes are required from consumer bureau, like all the companies who are non-microfinance, what do they need to report to ensure that there is complete 360-degree view of a household, that what is the obligation. So I think that's a prudent way of lending. To answer to one of your questions that you mentioned, that how the pricing will get affected. So I think with this circular, what has also happened, while there is harmonization and level playing field, it also creates a lot of competition. So now all people are competing for the same household. Nobody can give more loan or less loan to the same customer. Each one has to take into consideration the full obligation of the household, and then they have to give the loan. So I think with increase in competition, ultimately the customer benefits. So I don't see that there would be too much increase of interest rates from the players, but I think it'll be right pricing. Because at the moment right now, because there was a margin cap applicable, and the way the rules were designed, that for every 100 bips deduction, the MFIs were required to reduce interest rate by 275 bips. So that became a very difficult scenario in a downward interest rate cycle. But now as the cycle reverses, and we are seeing that like the margin cap is not applicable anymore, definitely the lenders can price the risk appropriately. They can look at the territories that they are operating, what are the kind of difficulties or challenges they face, and then price their credit accordingly. So I think that is the biggest achievement of this circular, and which helps basically everyone to price the risk appropriately. And I don't see that affecting interest rate very drastically, but yeah, there could be a little bit of change. And most importantly, I think the smaller MFIs, which were suffering more because their borrowing cost was still 14-15%, but their lending cap was still at a certain level because of the overall RBI recommendation. There was 2.75 multiple of the base rate, so which came down to around 21% interest rate, around 20.75. So I think their margins were really getting squeezed. So now they can price it appropriately, and then I think they have a little viable business model, more viable business model now. So this is something which is very good. I think the overall circular will ensure that there is complete transparency, because it is required to report your lending rates to the SRO, and even the banks are required to report the lending rates to RBI, and they will be published at a district level all across. So there would be transparency, and I don't think so there will be too much divergence between lending rates. You may see a little bit of a correction because of the rise in interest rate, but I think now an NBFC, MFI, or any other lender will operate like any other lending institution, where your treasury efforts will determine your margins rather than just the lending rates. So now if you are a better rated company and you have a better performance of your portfolio, you can obtain debt at a much cheaper rate and improve your margins from there rather than just increasing rates. So that is something that I wanted to share. The other question that you asked in terms of having multiple entities within the groups and how the regulations are kind of impacting us. So RBI regulations are designed in a manner that if there is one systematically important entity within the group, and if you are a subsidiary of that group, or there is a cross holding and stuff, so you are automatically get classified as a systematically important NBFC, or you get into that bracket of middle layer or upper layer. So those things get applied in a certain way. So we right now are in a middle layer. Our parent entity is in the upper layer. But definitely those regulations are applicable in terms of ensuring that we have adequate capital adequacy. We have our all the norms applicable in terms of audit and other stuff. At a upper layer, definitely there is a audit by 2 auditors. There is that requirement is there. So all of those are there, which I believe, in my personal opinion, is a good thing to have more transparency, to have a better regulatory infrastructure and in place, and which will in the long run will serve organizations definitely who are more compliant, and it'll be much more easier to kind of raise capital. And we have to recognize the fact that the industry is now moving from a predominantly promoter invested entity to now larger shareholding. So many NBFCs have gone public in recent past. Many are in the process of raising private equity and funds from other investors. So definitely it requires a little bit more transparent reporting structure, which is happening in the meantime. Yes, the regulatory guidelines which are getting implemented for NBFC MFI are in effect from today. And we had only a 15-day window. The regulation only came on 14th of March, and today it was supposed to be implemented. We as a system are ready, but I can't speak on behalf of everyone. There are people who are not ready, but I'm not complaining. I think these are regulations for good, and I think people will take a little bit of a time, but definitely they will come along and they will definitely be able to implement. I feel it's the right step in the right direction in terms of ensuring that the indebtedness of the borrower is taken into consideration, and overall health of an institution and NBFC is kind of in the right direction. Even the PCA norms that have been kind of recommended by RBI or NPA recognition in terms of 90 days, these are all positive moves. Because RBI doesn't want the NPA recognition to be deferred or the provisioning to be deferred. I think what will happen with PCA norms is people would have to, if not write off, provide enough to ensure that their net NPAs are below a certain level. So I think that is something which is very, very prudent and good. And we have to move towards Basel norms, and Basel norms are indicative of this. I think most of the NBFCs have already moved to Ind AS. I think sooner, I think the banks and other entities also move to Ind AS, the better it will be. It will be a much more healthier environment to operate in. That's my summation.
Great, Sadabji, very well covered, I think, and I'm very happy that the industry is welcoming this move of the RBI, and hopefully they were told that interest rate will not impact much on the borrower, because you see that it's not on the side of the borrower, rather it should be a treasury exercise for the MFIs, so that the borrower should not suffer because of this thing. That's a good thing. I think the regulations will help the industry, and the small MFI those were struggling because of that. Their borrowing cost was high because the rating were not that much high. So I think they will get some kind of cushion where they can pass on this cost to their borrowers, and they are regional players. So definitely they will be in a better position to pass on this thing. Thank you for your deliberation. Friends, now we have Balaji TK ji, who is the CIO, CDO of Orange Retail Finance. He is the person who has very, very good understanding of technology, of all the latest artificial intelligence, machine learning, cloud, many things actually, where he has worked on these technology. He is very well qualified, IIT, IIM. So he is the person who has a very good academic background also. And in the Orange Retail, I think he's doing wonderful in terms of the whole technology part. So first of all, thank you, Balaji, for joining with us. And as we are discussing that technology, the core of any organization now, basically for NBFC and banking, without technology, nothing can move actually. The fintech companies which are running offices from one office and they are serving the entire country. So this is a big move actually in different direction. So, sir, we would like to understand from you. I think whatever change has been brought by the RBI, will it impact the small NBFC, HFC, or MFI in their implementation of these kind of changes from the technology point of view? And there is one more thing which has been brought by RBI in the skill-based approach, that CBS should be implemented by the NBFCs or the MFIs or HFC, which have more than 10 branches within a certain period. So what is the meaning of that actually? What will be the impact of this CBS on the, so this will be the kind of more cost will be involved, and the compliance will be more. And so, because I'm not the technology person, so we would like to understand from you how this CBS, which has been come in a new new circular. So how the RBI would like to take it, and as a CTO or CIO, how do you see it actually? Over to you, and thank you very much.
Thank you, Ashish. Thank you, eminent co-panelist. Quite interesting to be part of this panel, and the question is created one was very, very interesting. First, from RBI standpoint, why RBI is making all these guidelines is since they've gone through this data for the past 3 years, where a big NBFCs, because of the crash, like it took almost a couple of years for the other NBFCs to grow. So I think getting into this data, now they put a lot more systems, framework, regulation right now for us. So previously there are only kind of a 2 classification, were only less than 500, above 500. Now they got this kind of a 4 classification. All this classification is completely based on a scale-based regulation, where they do have a kind of a starting with a starting layer, and then the middle layer, the upper layer, the top layer. All that is based on a completely with the based on kind of systematic risk they add. Since these 4 layers, this starting layer is a base layer where it comes with a less than 1,000 crore, and then the middle is above 1,000 crore, and then upper and top layer. The top layer they will classify when they need to be done. And as already people have been discussing on the NPS, previously all these non-banking finance companies, NP reporting is based on month, and whenever we close a month and consult, the NPS gets reported based on 90 days window, and then the DPD gets calculated. But once the regulator comes back and says like no, NPA should be based on actual date of disbursement. Okay, the challenge is for us, if you should say like we started with a two-wheeler. From a two-wheeler, then we started with a cash loan, and from a cash loan we went into a business loan for some time. Then we went into a loan against property. We started with a used two-wheeler. Now we have a complete product where customer can come on complete through digital platform. So from a traditional player, we moved ourselves to a completely digital player. If you see for each of our product, I do have a different disbursement dates, but the month and closing is common. Okay, the reporting of NPS is completely different there. Now what happened? I need to incorporate all this based on the disbursement date to report that NPS. Okay, so obviously since I do have a one set of team, and since my entire product core LMS, core loan origination collection system, or whatever the product which you build it completely in-house, and you have one tech team here. So for us, it's quite easy to change it. But I was thinking from a company standpoint where they bought this solution from a different vendor's perspective, and if some kind of a guideline comes, okay, we need to go back to all these players and ask them to fix this guidelines. Okay, there it becomes a little bit challenging because we need to make them understand how this guideline works and how what kind of things we do. Two things. One is from a disbursement standpoint, what kind of a compliance we need to do, and then from a reporting standpoint, what kind of a compliance we need to do. So these two things we need to take care of it very well. And what happens since you touch based on this core architecture, what we need to do, core financial system. So what happens is whenever there's a more than 10 branches, what is the RBI requirement is do you have your online presence of the data, visibility of the data, where the customer can able to see your data. What is the present loan balance? Like how we have a banking app, can you able to see all the information online? Okay, RBI is requesting all these NBFC companies where has more than 10 branches. Do you have this kind of a system? Can you just migrate to this kind of a system? Okay, where this core financial is nothing but consists of a loan origination, loan management, rule engine, a loan collection system. On top of it, we do have a kind of a core stack where the CRM, ERP is built into that. And then we have a supporting stack of RBA or kind of a regulatory supervisor layer, which called as audit management system or a big data or AML. And then on top of it, we do have certain APIs layers, which connects with the interface to the kind of we do give a customer portal, and also we do give a partner engagement. So this kind of architecturing is being proposed by an RBI, where certainly like already the solutions are available in the market. We can able to go and get it. And since most of the solutions right now is available on the cloud on a pay-per-use model, I think the cost from the solution standpoint is also not that much great, I would say. So I would say whatever the guidance given by RBI, the products are available in the market. You can go and get it, or if you have a team of technology team in-house, you can build it. It's between the organization, you need to take a call what need to be done. So that's my submission on this core financial models.
Okay, great, sir. Thank you very much. I think you have made the job very easy because you are told that these solutions are already available. So there will not be a big task for the CTO or for the NBFC, which are small. They will face any such kind of situation because these solutions are readily available. So friends, now I think that's time to take some questions from the audience because we have already crossed our time limit. So I like somehow Mr. Jatinder Singh could not join today because there was something urgent, very urgent. That's why he could not join. So he sent the message that please say sorry on behalf of him. And the next, I think, program, next webinar, he will try to be here. So we have one question for
Ashish, 1 minute. Your 2 questions are left out. I will take you 1 minute to answer those questions. One, you mentioned that why government companies are not kept in the upper layer, are proposed to be in top layer. In the circular itself, RBI has mentioned that government companies were given direction to meet the CRAR criteria by March 22, and that has to be seen. Therefore, they have been right now kept in the base layer or in middle layer, not subjected to the upper layer because of these reasons, because they are in transition state. That RBI has given a special exemption. Second, you mentioned that non-operative holding companies, if they are in X layer, why their various companies, HFC, NBFCs, Microfinance, are in different layers. If you see that non-operative holding companies are kept in the base layer only, they are not kept in any other layer, and the regulation are activity-based. Now the RBI has moved from entity-based to activity-based regulation. Therefore, wherever the risk is more, the concern, the category of the layer, they have been kept. This is my answer for those 2 questions. I don't know that I could make sense or not.
Very good, sir. I think very well covered. I think out of this one question also, which was left, which has came to my mind actually at the last phase of the discussion, the asset side. So RBI has given the asset side, not the AUM. So practically, we were discussing that asset side is the on-book side basically. So there can be some of the NBFCs or the MFI or HFC, they may play that they want to remain in the base layer where they will keep more off-book rather than the on-book actually. So from my point of view, I think they should cover up the AUM rather than the asset size for the classification of base layer or the middle layer or upper layer. So any suggestion?
No, and it is not like that. The guidelines very clearly say the asset size will be reckoned the book loan plus off balance sheet item multiplied by credit conversion factor. So if suppose a company, they have issued guarantee of 500 crore rupees and 50% is credit conversion factor, the 250 crore will be added in the asset side. In our regulation of RBI, our balance sheet item has not been given any leeway or any exemption, but they have linked it with the credit conversion factor and then they add into that.
Okay, so this will be referred to some other circular because in this circular they have given.
No, I think this is somewhere in that circular only.
No, sir, it is not there. Sir. I have seen their circular completely. This may be a mistake from my side, but I think it has been not noticed by me.
Anyway, ask question. I will look into my iPad if I can see that. I will tell you. Thank you. Go for questions.
Thank you, sir. Thank you very much for covering these things actually because these are very important things to cover up. So Sadafji, I think there is one question from somebody who is maybe a small MFI person. He's asking that how can an NBFC or MFI raise funds at 5-6% where they are getting money at 12% and above actually. So what can be the guidelines? What can be the roadmap for the person who can get the funding at the lower rate actually?
So there is no formula other than ensuring that you have a robust kind of a board structure, regulatory framework, better ratings, and that will determine only your cost of borrowing because there is no other formula. Yes, you have diversified sources of funds, so you can access NCD market, you can access CP market, which is not really conducive for microfinance company, but you can access debt capital from there. You can access ECB, you can access MLD. apart from the bank borrowing. But there is all of this is a function of your rating, and the rating is a function of your portfolio quality, your management quality, how well the company is structured. So I think there is no shortcut or a fixed formula where you can start getting funds at 5%, 6%. You can only get it if you put everything in place, that is your system, process, policy, your regulatory standards, everything in place, and get a better rating from a rating agency. So I think that is the only thing that I can say on that. One thing which is good, that companies, what I meant to say in terms of company A versus company B, if the size is same and they manage their treasury better, that delta, whatever they will save, will go to their margin. So for example, if my cost of fund is 10 and my competitor with the same AUM has also a cost of fund of 10.5, so that 50 bips, because I'm managing my treasury better and saving that extra cost of idle money, then that will go into my margin, which was not the case earlier.
Great, sir. Thank you very much. Sanjay ji, would you like to add something? Because you are involved in these practices also.
No, I think it is covered very well. That is all function of, corporate governance, your financial credit rating, and quality of the portfolio built in. So it is only determine, how you will be able to raise the funds. Of course, with certain efforts of the team and innovative working with various kind of debt market structures, you can make, certain bips here and there, but ultimately it is all a combined bouquet of the, overall parameters, which will provide you the actual outcome on your interest funding.
Okay, thank you very much. So, but more question is the last question, which I'll take because keeping in mind the time situation. So, somebody has asked that what is the maximum percentage of fund that an NBFC can arrange from a bank in co-lending actually. So, is there any limit by RBI for raising money by any or tie up by any NBFC from a bank for co-lending?
No, there is no assess on the quantum. It is basically whatever on the, retention wise, yes, the maximum is whatever 10, 90 is there. Otherwise, on the overall quantum, I don't think there is any limit.
Okay. Any comment on this, Tripathi sir? Hey, you are on mute, sir.
The only thing that in co-lending, they can only give 80% and 20% they have to keep. And for 20%, whatever the requirement is that they can take the funds. For the purpose of 80% funds will not be required. For the remaining 20% are doing other loans, they can borrow from the banks as per the leverage allowed. In case of HFC, it is allowed 12 times, but generally banks are comfortable at 6-7 times. In case of NBFC, I think 4 or 5 times of the net own fund they allow. That is the same model they have to follow. If the question is that only, then my reply is this. Okay. And a second point which you are asking in same circular at page number 12.
Okay.
At page number 12 is mentioned top NBFCs, excluding top 10 NBFCs based on asset size, which automatically fall in upper layer, bracket band, based on their total exposure, including credit equivalent of balance sheet exposure.
Okay.
Yeah, they have mentioned only one line. That's why it I have missed out.
Okay, I missed out from.
I read so much as I remembered.
Okay, great, sir. Great.
I just saw it.
Thank you. So now I would like to end the session, today's session. I would like to say that it's a really wonderful session where we could, I think, refresh or warm up ourselves, or the audience will get some advantage of these regulations because the industry veteran has come and they have discussed what will be the implications. So I think overall, all the panelists have given the view that it's a good move actually, where the RBI is coming out these regulations which are bringing more parity between banks and NBFCs, and the longer run the NBFC will get this the advantage of this. So I think this is a good thing that everybody is in the same positive note that this will help the entire industry. Even the small and mid and large, all kind of NBFCs will get the advantage of it. And in future also, RBI will try to bring, I think the parties are giving some area where external benchmark or something where the RBI may come out with that regulation also. So, and some of the analysts have also told that it will not impact much on the health of the NBFC because there may be a short-term hit on the notional thing where the percentage of NPA might be a little bit higher, but maybe within 3-4 quarters it will come back. And then one more, I think, outcome has come that that was a fear in the mind of the borrower and the banks and other players that the interest rate will increase to the microfinance borrowers and all. I think Sadabji has given very good, I think, answer that it will rather there will be the cost may be rationalized because the players who are into MFI space they will I think keep in mind that other players are also there. So there will not be much on the impact of the much of the impact on the borrowers, the cost to be charged to the borrower. So all these things are very, very positive from the industry point of view, from the borrower's point of view. I would like to thank you to all the panelists from core of my heart for coming in this webinar, sparing their time, valuable time, and giving their feedback, their deliberation, their suggestions, and their views on the different circulars of RBI. And I would like to thank you to all the participants for making it more interactive and joining with us. And I would like to thank you to my team members, the Resurgent India team, who have done very hard work to make it successful. So Rohan or the Devesh and the Lokesh and the NBFC team, Mr. Atul, the Chetan and the other people who have done very hard work to support me on this webinar where they have prepared the presentation, they have given me the talking points and everything. So thank you very much. Thank you once again to all of you. And I wish you the very, very happy new financial year to all of you. Thank you very much.
Thank you.
Happy Gudi Padwa to all of you.
Thank you.
Thank you,
Thank you,
Ashish
sir.
and
Thank
my
you
dear
very much.
co-panelists. Thank you all. Thank you.
Thanks, everyone. Thank you so much, sir.
Everybody.